Hello everyone, this is Zak Gardezy. I'm the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So on this episode of Money Minutes, I want to talk to you about portfolio positioning, specifically here at Wealthstone. What are my views looking at the market now that we're 1 month in to 2026? So let's get started. Okay, so how am I positioning portfolios right now? For most of my existing clients, for new assets that are coming into the firm, the general positioning is clients should be less risky than we have been over the last couple of years. And what does this mean for most clients? It means having an elevated cash position. And so for most Wealthstone clients, I've increased our cash position. Now, this cash is mostly invested in high yield, for example, money market funds, US Treasury-based government money market funds, which still pay good interest. I mean, we're seeing in the mid 3% rate. And so for a risk-free place to be, this is a great position to have in this environment that I'll be talking about. So number one, our positioning is less risky than we have been, and basically removing some equity exposure and increasing our cash or money market exposure in portfolios. Now, the question is, why do we have this positioning? So there's really three main risk factors. Number one, geopolitical. We all see it. Actions the US has taken in Venezuela, Greenland, and what does this have to do with NATO and our NATO alliance and our relations with the European Union and trade in Europe. And then additionally, the geopolitical risk is quite severe because if we take, for example, China could look at our actions in Venezuela or in Greenland and think, you know, we have been considering taking over Taiwan, which Taiwan still makes most of the world's computer chip supply. And as we look at the S&P 500, it is heavily dominated by technology stocks. At this point, over 40% plus of the S&P 500 is heavily reliant on technology. They are technology stocks. And even stocks that aren't technology stocks, they rely on artificial intelligence and technology. So you could say most of the global economy, and especially the US economy, is reliant on computer chips. And so our actions, if they do influence or somehow justify China taking over Taiwan, that would be a severe catastrophe for global markets, especially the S&P 500. So geopolitical risk, in my opinion, is extremely high this year. Now, economically speaking, the big news, Kevin Warsh was elected or selected as the next Federal Reserve Chairman. As we know, Chairman Powell, his governorship, his chairmanship is ending in May. And so this new chairman will take over if, approved by the Senate, which should be an easy proposition. Kevin Warsh was the top two choice. So there was Kevin Warsh and then the White House economic advisor. The White House economic advisor, I believe, was potentially the worst choice because it would have been completely in lockstep with the White House. And this independence of the Federal Reserve is extremely important. And so Kevin Warsh actually being a former Fed member, this gives a lot of confidence to the markets. Now, what we did see when he was announced as potentially the next Federal Reserve Chairman, we saw the markets come down, but we also saw commodity prices, for example, gold and silver, come down very sharply. Now, why is this? That's because Kevin Warsh is the lesser worse choice in terms of inflationary impact, because both of the top two choices are saying they want to bring interest rates down aggressively. What will that do to the economy? Well, we're still seeing elevated inflation. So if you bring down interest rates, which then creates a boom in the economy, you're going to see the housing market, asset prices, borrowing increase, which will then cause the US economy to grow significantly. Now, in this situation where you have this basically sort of explosion of growth rapidly, you're going to have a rebound of inflation. And why do I have this opinion? Well, take a look at the 10-year Treasury. We have this environment where all the signs are pointing towards interest rates, the Federal Reserve bringing interest rates down. So why isn't the 10-year Treasury coming down? The 10-year Treasury, in a way, helps predict the next movement of interest rates in the economy. Well, The 10-year Treasury also helps us figure out what's going on with inflation. If the 10-year Treasury stays elevated or moves higher, that could be the way the market is saying, look, maybe the Fed keeps rates high or has to go back to raising interest rates because of a rebound of inflation. So we're seeing that in the Treasury market. And although gold and silver prices did come down, they're still very high, near record highs. I mean, we just saw gold hit over $5,300 per ounce. And so this is the other way the market tells us inflation is expected to go much higher. And so although Kevin Warsh is a more reasonable choice, it's still an inflationary choice. And so we're seeing the economic risk of those actions. And it's a tale of two different stories. Economic data coming from the executive branch is showing us that inflation is actually coming down. The job market is relatively okay. So we see some confidence through the economic data, but then the market and investors are telling us a very different opinion. So we'll have to see how that plays out. I'm more bearish there as it relates to the inflationary risk. Now moving on to the third issue at hand, this really has to do with stock prices. So stock prices are very elevated, and especially when factoring in these various risk factors, you can make the case that why is the S&P 500 hitting all-time highs? Why are tech stocks continuing to climb? However, in the midst of all of this news, the geopolitical news, the Federal Reserve news, we are seeing the Mag 7 have a very rough start to the year. Some of our key players, stocks that we like here at Wealthstone, are having a rough start. And so this tells us that the market is starting to get wiser as it relates to their own risk levels. And frankly, as I've been talking to clients throughout the last couple of weeks, and even as I released my end of year memo to clients, I talked about the risk levels in 2026, in my opinion, are higher than the potential reward. So we should be a lot more prudent going into this year. I raised cash levels for clients in December at the end of the year. I believe this was a smart move, and we're already seeing significant movements. We're seeing significant risk and volatility in the first month of 2026. I believe it'll be a long year. I think in the end, it will be a rather positive year, but with significant volatility, and with volatility comes opportunities to buy. So although we have elevated cash positions, it's really more of a short-term tactical move that I think we'll have a great opportunity at some point this year to take advantage of and purchase a lot of these stocks we like for the long term. Because it's not like this year is going to be the end of artificial intelligence or we're going to somehow regress technologically. We're still going to advance technologically significantly. I still believe in the long-term thesis behind AI, quantum computing, autonomous technology, robotics, all of these different things. However, during any period of industrial change, big industrial revolutions, you're going to have ups and downs. And so this could be one of those revolutionary years in terms of a negative impact to the stock market, but an opportunity nonetheless. And I can't end this video without talking about, of course, the midterm elections that we're going to have at the end of the year, which we're looking at the betting markets now, because nowadays you look at poll numbers and you look at betting markets. The betting markets are telling us the Democrats will take over the House of Representatives, and then there will be a Republican Senate, which generally means not a whole lot of action, not a whole lot of changes coming from our Congress, and the president really can't get a whole lot done. So you'll take that how you will. That's generally a good thing when the Congress is divided and the president is a Republican or a Democrat. A divided Congress, a lot of things don't change. Markets tend to like that. But we'll see. It'll be a very interesting election, but it'll be a very, I think, long year ahead. If I were to summarize my overall opinion of 2026 and how I think it'll go, I think it'll be a risky year and one that we should be very cautious investing in. And investors, especially here at Wealthstone, I'm advising them to be more prudent, align your investments closer to your risk tolerance, and let's take advantage of any good opportunities that this year brings us. So thank you so much for tuning into this week's episode of Money Minutes. If you have any questions, please feel free to reach out.